So we are going to get started. Good afternoon, everyone. This is Kathy Neifeld. I'm one of the partners with Agency One, and we are delighted to bring to you today our friends from Prudential, specifically Tim Uecker and Lenny Paul. And the subject of today's webinar is Bear Market Triggers and the RSVP. I thought that was a great title. The RSVP stands for Recession, Shocks, Valuation, and Policy. And Tim is going to take a deep dive on all four of those topics. Tim is a managing director at Prudential Global Investment Management. I just learned that's what the PGIM stands for in his bio. And since 2002, Tim has been with PGIM in the field to sub-advisory clients in the United States. Between 1997 and 2002, he was a divisional sales manager for Munder Capital Management. And before Munder Capital, he was a vice president at PIMCO Advisors, where he wholesaled mutual funds in the southwest quadrant of the United States. Lots of experience with the markets and with different funds, an expert certainly with Prudential and recognized in the field. We are honored that our friends at Prudential have made Tim available to us to share his opinions about what's going on in the marketplace right now. The webinar is going to take about 30 to 35 minutes. Tim is encouraging that we ask questions, and if you would be kind enough to, if you have any, to type them into the chat or into the Q&A, and we're going to try and address them as they come in. When I find an appropriate place where I can stop Tim in his tracks and not distract him and see if we can address them in a timely manner. Additionally, our regional VP, Lenny Paul, is with us from Prudential. Lenny, thank you for everything that you do, and we'll be contributing when appropriate on different product opportunities that Prudential offers to help provide solutions for your clients. So without further ado, I'm going to turn this over to Tim Uecker, and I know that we are all going to learn a lot, and hopefully we'll end this webinar feeling very positive.
Well, thank you. And thank you for all of the work that was done in setting up the call. And thank you all for dialing in and giving us a portion of your day. On behalf of everybody at PGIM, thank you. Thank you for the business that you've sent our way over the years. PGIM is the 10th largest asset manager on the planet. And we couldn't say that without your investment. Lenny, we couldn't say it without your work with what you do for us. And PGIM is actually a collection of boutiques that some of you may already be familiar with. You may already most likely have money with us. But the boutiques are Jennison Associates, really your traditional bottom-up stock picking firm. It's also our quantitative solutions division, very much a top-down version of that. And then our largest single boutique is, surprise, surprise, we're an insurance company. We manage a lot of bonds. PGIM fixed income alone is over $1 trillion in assets. And then we have PGIM real estate. We've got some private equity, private credit, really a lot of different areas. Suffice it to say that if there's an investment area that's attracting capital, good chance we probably have our fingers in it. But where I will lead us to today are some solutions for investors within the VUL Protector life insurance contract. Some of these are on some of the other life insurance contracts that you work with Lenny on. But collecting all of the different thoughts and ideas and perspectives, we think it's done best with this topic that we have today, this RSVP framework, Recession, Shock, Valuation, and Policy. We think we cover a lot of ground with this. And when you do look at bear markets in the past, when markets have pulled back and stayed down, typically the culprit is either one of these or two of these, and in some cases, all four of these. I'll walk us through our particular perspectives on these. I'll get a little bit more tactical on where we're shifting some of our overweights and underweights. And then I will end on some specific portfolio solutions that you can execute on. But if there are questions, by all means, raise a hand and we'll address them as we go along. We do have a screenshot that we wanted to share. Thank you, Lenny. This is really the front page of this. It's a double-sided one-pager. And by the way, this is client approved all the way down to the kitchen table. So you can use this with clients. You can use this with prospects if you'd like. We update this every month. I think we just came out with the July version. Hasn't changed a tremendous amount from the June version, but I will highlight a couple tactical moves that might be a little surprising to you. But let's start with the R of RSVP, recession. And when I did these calls at the beginning of the year, we were a bit more concerned than what we are now with respect to the risk of recession. So I have good news. You know, the third quarter of last year, the fourth quarter of last year, we were growing the economy at a decent clip, 2.8% in the third quarter, 2% in the fourth quarter. And then in the first quarter of this year, we went negative. The GDP number in the first quarter of 2025 was actually minus 0.3. Not a lot negative, but negative enough that it really got a lot of people's attention, because if we would print a second quarter GDP that's negative, now we're all going to have to sit here and read about the risk of recession. But when we go back and look at the first quarter here, we essentially bought a lot of our growth. Really, we pulled it forward. There were a lot of companies that were buying into their inventory in anticipation of tariffs, making goods and services more expensive. And there's two ways you can grow your economy. One is internally, or the second way is to grow it. And we really, when we bought that growth, you have to back that out. How much are we actually making ourselves? Imports were a big portion of the first quarter GDP numbers. But I'm pleased to say that in the second quarter, numbers have gotten much, much better, roughly about up 1.6%. That's going to get revised. And then ultimately, I think you hear this in the news, that over the course of a full year, these quarterly numbers, they get annualized. But over the course of the full year, it's still projected that we will grow our economy. The economy will be bigger than it was last year, about 1.6%. So I think that's good news. The risk of recession, this first R here, and you can kind of see our gauge here where that yellow dot is. If it would have gotten further to the right, we actually changed the color to red. But where we're sitting right now, we think that we're looking at the risk of a recession is receding. And the last thing I would say about that before I move on is typically we often take about 2 steps forward and 1 step back, and it's been a while since we've taken a backward step. So we're constructive with respect to that one element. If there again are questions, by all means type them in. We'll address them as we go along. But the second part here of our RSVP framework is shock. And we actually wrote this in underneath the word shocks. Typically unpredictable. That's why they're called shocks. If they were predictable, we'd call them predictable events. And we always have the risk of shock a little bit to the right of medium. Inflation is one of those areas of concern. Will there be a negative surprise? And then you look at some of the geopolitical risks that are out there, whether it's the war in Ukraine or Middle East tensions. And this has been an area that it has ticked a little bit further to the right. And what we've seen capital do here is capital has gone into commodities as a store of value. It's also starting to take positions in some of these stable crypto things that you're hearing a little bit more about. But I think on balance, we seem to be able to withstand these unpredictable events when it comes to equities here in the United States. The third part, valuations. Here, I think a lot of people would agree that it's hard to argue that stocks are cheap. When we look at the S&P 500 forward multiple, it's actually ticked up from about 20 to 21 historically. Mid to high teens is kind of the average. So we are above average when it comes to valuations. And one of the things that you really hire us to do is to find where can we find value in the marketplace. And for about the last year or so, and we're not the only ones that have seen this, we've gone overseas for valuation, specifically into Europe, Australasia, Far East. That's the fancy way of talking about the EFA index. And EFA's valuation is roughly half that of the United States, where now we're sitting at a S&P 500 forward multiple of 21. The EFA index was sitting at 13. It's climbed up. A lot of capital has flowed into EFA specifically because of how cheap that area has been. And those valuations have climbed from 13 to 17. So now there's only really a 4-point difference between the S&P and EFA. And I'll talk about that when we get tactical on how we're adjusting to this. And then the last part of our RSVP framework is P for policy. Here we're talking about primarily monetary policy. And by that, I mean, what is the Treasury doing? What is the Fed doing? As opposed to fiscal policy. Fiscal policy really came again into the forefront in the first quarter of the year with respect to tariffs, trade negotiations, and how we do business with other countries. But for the most part, we spend our time focusing on monetary policy. What does the shape of the yield curve look like? What interest rate might the Fed reset the overnight Fed funds rate to? And that's also in the news, probably a bit more than what it typically is. But we are looking at a yield curve that's really asking for the front end to come down. You've got a yield curve that it's kind of in the shape of the Nike swoosh, where the front end is higher than the 2-year, it approaches the 10-year, and then the 30 years is a bit higher than the 10-year. But right now, the front end of the yield curve is sitting in the low fours. We're anticipating that interest rates will come down. The front end of the yield curve will fall, and that ultimately we will have a normalized shape of the yield curve where short-term interest rates are lower than long-term interest rates. You should be compensated for taking on the risk of time. And one of the things we're seeing this manifest itself in the marketplace is the emerging leadership, once again, of a lot of financials. Financials do much better when the yield curve has its classic shape. A couple other things, though, to not ignore when we look at currency, the strength of the dollar. We've seen a pretty big pullback in the first half of 2025. We've seen the dollar decline by about 10%. We haven't seen that type of a decline since really the early to mid 70s and going into the Nixon administration. And we like to have a strong dollar, but at the same time, if the dollar comes down, that makes our goods and services a little bit cheaper for people to buy, will help our exports. So you'd like to have a strong currency, but maybe not so strong. So we look at the decline in the dollar as something that's got our attention. Really, it's an indication of the fiscal concern with the U.S. Economy, more so than any monetary concern. Okay, so I've kind of marched us through the RSVP framework. A lot there to cover. There might be some questions that you might have at the bottom here. This is really our long-term bias. For the last 100 years, our market, the S&P 500, attracts capital. I think all of us have seen this. Some of you might have versions of this framed in your office on the wall, but it just really also highlights where some of these culprits have been when we've had extended bear markets. Going to my next page, now we're going to get a little bit more tactical here. We have separated the capital markets into five major asset classes: stocks, fixed income, real estate, commodities, and cash. That's the top, the gray area. And then the blue boxes themselves indicate where we are neutral, where we are underweight, and where we are overweight. You could see here within stocks, we're neutral. Fixed income, you might be surprised to see this. I'll talk about this, is that we are underweight in the asset class. But notice where we are in cash. Cash, we are overweight. And the reason why I think this is important is if we are looking at the front end of the yield curve coming down, yeah, that's great. And often people would say, well, if interest rates are going down, don't you want to be long duration? Wouldn't you want your existing bonds that have a higher coupon be worth more? Wouldn't the price of those go up? And we're looking at the risk profile here of the duration of fixed income overall versus the duration and coupon of cash. So the duration of cash is 0. The coupon of cash is over 4. And the reason why we're underweight in fixed income, overweight in cash, is we're sitting and waiting. And we're not taking a lot of risk while we're waiting, because it's very possible that the front end of the yield curve could go down as we predict. But it's also very possible that the middle and the long end of the yield curve could go up, and you could see price weakness exhibit itself there. We don't know. That's why we kind of have this strange position: underweight in fixed income, overweight in cash. Real estate, this has been an area of overweight for us, but this one indicates we're neutral, mostly because commercial real estate had just been so beat up that we couldn't continue to turn our back on some of the opportunities in that space. And then commodities, this shows an overweight. We have moved this to the left. We've made a lot of money in commodities. I don't think I need to tell you what gold is up year to date as a great example of a store of value that people have just run to. We know that trade isn't going to last forever, and we've taken some profits there. We've actually moved our commodities closer to a neutral weight. Now what we do is we actually break out the two major classes of stocks and fixed income, and I'll get into these a little bit. This one shows an underweight in U.S. stocks, and there we're essentially expressing that through the S&P 500. Below that, you see EFA as a slight overweight, and below that, you see emerging markets also as a slight overweight. This has happened pretty quickly, but we've taken profits off the table with EFA and emerging markets. We've moved them to neutral to a slight underweight. And then with U.S. stocks, I've never seen us do this in this short period of time, but with U.S. stocks, this shows clear to the left. We've now since moved U.S. All the money that we made in EFA and emerging markets, we're bringing it home. We're putting it in U.S. stocks, and we are as overweight in U.S. as I've ever really seen us. And then within fixed income, this gets a little wonky, but the one area that I would highlight is high yield. Right now it's a neutral. We're looking to expand that as we gain more confidence here in the United States. Not only is that good news for companies as the fear and risk of recession has receded, as we're overweighting the equity components of these companies, would you not also want to overweight their fixed income components? And that really is an expression of the healthier balance sheets that you really have to research when you're buying high yield. So I've gone through a lot of different things here. We've talked about the yield curve. We've talked about our position on interest rates. And one of the questions that I often get with respect to interest rates is, yeah, we feel they may go down, but what might the Fed do if inflation starts to become a negative shock and starts to reemerge? And it's almost a rhetorical question, because I'll ask everybody on this call, if you were the Fed, what would you do? You kind of have a box that you're in. If you raise rates, you do that to cool off prices, really to take the punch bowl away. If you have an economy that's weakening, you want to goose it. You want to lower rates. You want to decrease the cost of capital so companies continue to have full payrolls. Maybe they execute on some of their growth strategies, maybe hire more people. So you have this box. Should the Fed raise rates to fight inflation, or should they lower rates to keep employment high? And I think what we interpret is the Fed is like, look, all things being equal, we'd rather you keep your job and pay a little bit more for a gallon of milk or the proverbial price of eggs. They'd rather keep employment as high as possible, and that's why we have this bias towards lower rates in the future. Near future, here we are in July already. It's very possible we could get one rate cut before the end of the year. I think it'd be a bit much to think that there'd be two rate cuts. It could happen, but ultimately, what we really look at is the shape of the yield curve. Okay. How are we doing on time? Do we have any questions so far?
We've got plenty of time, and we do not have any questions so far.
Okay. Let me keep going a little bit further here. And now I'm going to get into some of the portfolios that are available to you on the life insurance platforms. For a lot of years, I think close to 4 decades now, one of the most popular choices is the stock index portfolio. Surprise, surprise. It's very simple. Everybody understands what it is. It's the S&P 500. The fee profile is very efficient, partly due to how popular it is and the size of the portfolio. But the stock index portfolio has been very popular. One feature I would point out is that in managing the stock index portfolio, we own all of the stocks in the S&P 500, which means we get all of the dividends that the S&P 500 pays. Often, you might have a stock index portfolio that is just based on the price movement of the index. With us, we're actually buying all of the stocks that make up the index component. And on the left, you see these certain facts of the portfolio. One of the facts I always like to point out to people is the number of positions in the holding. Right underneath fund characteristics, you'll see that the fund characteristics, it's actually not 500 names. It's a little bit more than that. Maybe you can have fun and impress your friends and family at a cocktail party, but the number of holdings is 509. How can that possibly be? You do have some stocks that have like an A share or a C share or a B share. That's really what that means, is that we own the company, but there might be 2 different classes of shares that are in there. That usually gets cleaned up and reconstituted approximately once a year in the summertime. And then you can actually see the PE ratio is May 31st. It's actually higher than what I was quoting. It's closer to 25. So, given this portfolio, there's been a lot of talk, a lot of questions, a lot of demand for how else could we perhaps invest in the S&P 500. Now I'm getting into Lenny's realm here a little bit with some of the recent upgrades to the VUL protector. And maybe, Lenny, this is a chance where you and I, we kind of toss the ball back and forth here a little bit. But we've actually introduced 3 very new portfolios. So to complement the stock index portfolio, we've actually launched another portfolio that highlights another way you can invest in the S&P 500. You don't have to own all 500 stocks, or in this case, 509. You can own an option on the S&P 500. I'm sure many of you have seen this. It's probably come across your desk. The way that we do this, we use the ballast portfolio. It's what we call the ballast portfolio. It's managed to a 60-40 benchmark. And the idea here behind an option is very simple. An option on the S&P 500 doesn't require all of your money. And you can maintain and gain exposure to the extent that you want, in this case, 60% of the portfolio, without taking 60% of your money to do that. It takes maybe about a third of that. So you gain exposure to the S&P 500 to the extent that you want. And then what do you do with the rest of the money? We essentially put it in our pocket. We put it in short-term fixed income securities. Again, the benchmark here is 60-40. We're using options. And when you get into the dynamics of how this works, what a lot of people like is that with an option, great, you get the upside, and when you're in the money, wow, it really starts to leverage up, and you can actually make a lot of money in options. The catch is they expire, and you're always having to maybe re-up or raise your strike price if you're in the money. And on the downside, and I think this becomes very attractive for investors that certainly long-term inside of a life insurance contract, but maybe they would like to win by not losing so much. What kind of a strategy do we have where we can somewhat slow down the loss? And that's the way that an option also works. Because if the market falls down, you're not going all the way down with it, because you're only out the premium that you paid for the option. And without us really doing anything, if we have a down market, this thing by itself turns into a bond fund. If we just let the option expire, we don't do that. But the idea behind the balanced portfolio is we capture about 60% of the market's upside. That figures. But we really only capture about 30% of the downside because of the dynamic of the way the option works. So I know this is a little wonky, but it's a nice next step from the straight stock index portfolio. We're giving you the options. We're putting them in your portfolio. You'll see what the strike price is. You could see where the expiration date is, being the top 10 holding of the portfolio. And really the end result of this is that you're getting all the gains. You're going to suffer all of the losses to the extent that we can mitigate that for you. But it's an option strategy where there's no cap on the upside. You get all of that. And then a lot of people ask, well, could you do a little bit more than that? And we've added two more strategies beyond that. So we really have four options when it comes to the S&P 500. The first one is the straight index, owning all of the stocks. The second option is, hey, we'll buy some options for you, and you'll go up and down with the value of those options. The third and the fourth are what we call the laddered allocation buffered 12 and the laddered allocation buffered 20. What that means is that we're buying monthly tranches that have buffers in them. We do it through options. The laddered buffer 12 means we eat the first 12% of loss, and the laddered buffer 20 is we eat the first 20% of loss. Wow. A lot of people are like, hey, that makes me feel pretty good. You guys are willing to withstand and take off my shoulders these losses. And the way we do that is through owning 12 different monthly ETFs. And each of those ETFs has that 12 or 20 buffer. Now, the catch is we're gonna need something on the upside. There are caps that come with this, and they change every day. It's a little bit harder for me to quote, but we do have approximations. And the way that I look at that is the ladder buffered 12. Typically, we'll have a cap somewhere in the low to mid-teens. And again, that changes every single day, a little every single day. So I can't quote you a specific cap. But then on the laddered buffered 20, you can expect if we're going to eat more of the loss, we're probably going to ask more of the gains. And the cap on the laddered buffered 20 is high single digits to low teens. This is appropriate for a contract that wants the features of life insurance, but also really wants a safe bet when it comes to investing in equities. So,
hey, Tim,
yeah.
we've got a couple questions before we move too far away from what you've presented so far and where we're going. Would this be a good time to?
Yes, please.
Okay. So the first one is from Gil Zapata. I hope I'm pronouncing your name correctly. And it says, being a fixed income equity advisor, essentially the value proposition, it all looks too good to be true. CAT, CAG, WFC, CFR, WDFC. His question is, are you focusing your equity to basics and value with good dividend structure?
Wow, that's a good question. So within equities, yes, we have value portfolios, and of course we have growth portfolios as well. I think what I would probably say, and maybe we can go back and forth on this a little bit further if I need to go into more detail. We do have offerings in all of those spaces. Equity income is going to have high dividend. Probably one of our more popular equity portfolios, the Jennison Growth portfolio, which is the name implies, has a lot of consumer discretionary items, a lot of technology in it, really your traditional growth space. We also have value. We want to make sure that we have buckets available wherever an investor wants to go, and we mix them all together. I don't want to ignore a couple of the portfolios that we also have, and that's our 50-50 balanced and our flexible managed portfolio. Flexible managed portfolio is the one that I personally own in my life insurance contract, along with the S&P 500 and the Jennison Growth portfolio. Those are the three that I own. I put half of my money in flexible managed because it really is the kitchen sink. It will have growth. It will have value. It will have equity income. It will have dividends. It will have fixed income. I also wanted more beta. I wanted more market exposure, and that's why I put another 25% in the S&P 500, the stock index portfolio. Plus, I like the fact that the fee structure, it lowers my overall fee. And then the last thing I wanted was high alpha with the Jennison Growth portfolio. That's always going to have high standard deviation. It's always going to move around a little bit. But for my life insurance contract, I expect this to be in force, pay my premiums, really for my kids, and that's hopefully a long ways down the road. But those are the three that I own. Hopefully that adds a little color and insight to that really good technical question.
Yes, and then Mr. Zepeda further commented that his growth policy is inflation becoming a stepchild for action. Nixon years, Fed Chair Arthur D. Burns from 24% in January was in December at 2%. Severe steps, but it worked. I don't know if you care to comment.
Yeah, I think if you go back in history, that is probably one of the best cases, and maybe Volcker's moves also at the beginning of the Reagan administration, where we had really runaway inflation. And what are you going to do to break it? And the way you break it is you put the economy in reverse. You take away the punch bowl. You raise rates to a point where people stop buying. Companies can't put more price increases on the shoulder of companies or consumers. The risk you run is that, okay, once prices either stop or start coming down, the risk you run is you get into deflation or stagflation, which in some cases is almost worse. I'm going to wait to buy my big screen TV. I'm going to wait to buy my big durable good like a car because I know it's getting cheaper and nobody does anything. So I think that's really a tough balance that the Fed's dual mandate, which I think really was articulated after those specific events. Do we have the nerve to break inflation by putting our country in reverse and creating recession? We really don't want to do that. And I think right now where the inflationary pressures are coming from, they seem to be a little bit more palatable. But like I said earlier, the Fed would rather have us keep our jobs and pay a little bit more for goods and services.
Thank you. Another question that came in from someone who does not want to be identified said, if we are waiting for the Fed to lower rates based on the outcome of the tariffs, and the argument is that the tariffs are going to cost the American people higher cost, why are other countries lowering or have already lowered their rates under the same conditions. The
Yeah.
person further comments, Trump seems to be getting the better end of all of the tariff negotiations so far. And then I love the final comment. Please explain this to me like I am a sixth grader.
Well, really, the goal of a tariff, let me start there, is to discourage purchasing of goods and services overseas. It's to encourage domestic consumption. And then the other goal of a tariff is to raise revenue. And that revenue comes from the domestic companies as those goods and services essentially get off the boat in Long Beach or New Orleans or whatever the case may be. That's really the goal of a tariff. Please, will you stop buying your rubber hoses from Pirelli in Italy? And would you please buy them from Gates in Denver, Colorado, or something like that? That's really the goal of the tariff. And I think, as all of us have seen, tariffs have been around in different shapes and forms and numbers forever. And I think some of the bullish cases for tariffs are that, okay, it might maybe help to maybe level the playing field a little bit, where I think we're learning what we were being tariffed on versus what we were charging tariffs on outside goods was out of balance. Can we get that into balance? And I think that's the bullish case. The bearish case is, yeah, okay. Now we're going to have to deal with their prices going up on which goods and services. That's one of the tough things. And if you look at some of the emerging markets, some of the developed countries, not all of them are in a place where they're importing a lot of goods. A lot of money that we made, especially in emerging markets, were in countries where most of their economy was inside of their own borders. They weren't importing rubber hoses from Pirelli in Italy. They weren't importing any rubber hoses at all, so to speak. It's maybe a bad example, but tariffs do affect different countries in different ways, partly depending upon how big is their economy, what do they have to export, and do they have a robust international trade infrastructure. Nothing really competes with the United States on that. And so coming back to maybe that question of how is it that other countries might be affected differently, I think you have to examine. I'll take Australia as an example. A big part of Australia's economy is precious metals, commodities, things that are really used to make other things. And one of the challenges that Australia has always had is they're just so far away, so the shipping costs are very high. What type of a tariff or trading hurdle does Australia really want to set? Not very high. So tariffs is not really a tool that's much of a benefit to the country of Australia. I use that as an example. What else do we have, Kathy?
We've got another question, and then we can go back to the presentation, and then we have a comment, which I will get to a little bit later. The question is, since the Syracuse study in 1989, the 100-year chart for the TSI rates were 92% below 4% long-term. The question may be now, if the rates go lower, how long will it be before they rise above the 4% to 5% range again? And then furthering, bonds continue to drive the equity like a locomotive, question mark.
I would agree. The bond market's driving the bus. When you look at the long-term history, I think our conversation then goes to what is the real return of fixed income. Right now, the coupon rate, I'll just use 4% as kind of a benchmark here. If inflation is running at 2%, your real return then on fixed income, 4 minus the 2, is 2%. 2% real return on fixed income. If we lower from 4 to 3, and let's say inflation ticks up to 3, well, now your real return is actually zero on fixed income. So I think the question does imply that there could reach a point in time where, yes, we're lowering rates, we get the yield curve to the shape that we want it, but are we goosing things too much? Have we lowered too much? That's really part of the parlor game of predicting when and how much will the Fed lower rates. Does the Fed need to lower rates right now by a full point? Probably not. Typically, they telegraph it well in advance, 25 basis point increments. That's what we expect. I would start to watch to this point. I would start to watch actually something else, and that is every day the Fed has actually the Treasury has new auctions of bonds every day except Friday, and the world stands about 3 deep every day to buy our bonds. What I'm describing is the bid to cover ratio. So every day, whether it's the 90-day or maybe a 20-year or a 13-week, every day there's bonds that are being sold back into the marketplace. The market's standing 3 deep, bid to cover ratios are high. The great benefit to us is that the bonds that we're selling, we probably just got done printing them. The demand is so high for our bonds because it is the world's reserve currency. Whether you want it or not, you got to buy some of these bonds. What I would watch for, and maybe this gets to another point of the question of the attendee here. What I would watch for is if you started to see the bid to cover ratio start to fall. Maybe instead of 2.6, maybe it goes to 2.5, 2.4. And believe me, you'll know about it because they'll have a conniption on CNBC. Oh my gosh, the sky is falling. The bid to cover ratio of our latest bond market was not just weak, it was horrible. Maybe it goes to 2. And then what will happen is, okay, all right, we're selling our bonds. How much do we have to pay you to buy our bonds? And now the interest rates will start to climb. So getting to, I guess, a long-winded answer to the question here is, how long would it take and what might be the triggers for interest rates to go back up? It most likely would be a weakness in the bid to cover ratio of that auction that we send out every single day that a lot of people would perceive as a dent in the status of the dollar as the world's reserve currency.
Terrific. We can get back to where you were in the presentation. I think that we were just finishing the laddered approach.
Yeah, let me give you a break from talking for a second, and just kind of want to jump in. I mean, I've loved this. I think this is great, right? And it reflects I think Lisa and I were trying to come up with a different type of presentation than you've been having the rest of the summer of the year, and a reflection of what makes kind of Prudential's relationship and our products different. There's not a lot of other carriers that have that top 10 global asset manager under their umbrella. When we say we have 50 million customers in 40 countries, PGIM is the major part of that. PGIM is one of the biggest reasons why Prudential is the number one carrier within Libra with 21% market share. That why we're the number one VUL company in survivorship and accumulation in protection, even though we're not the number one in price, because we bring a certain value that you only get when you have a partnership like this. And when we have partnerships like with Agency One, and we can kind of bring these together. So when Tim is talking about this, we kind of get these insights, it feeds how we build products. So if you've paid attention to how VUL Protector 2025 version was repriced this year, yeah, we can talk about how the guarantees have changed, how the price has changed. One of the biggest takeaways is that we narrowed down the fund partners we work with, and we expanded the amount of funds we offer. So now we have 66 funds. And a lot of like what Tim was mentioning, they're not just all equities or bonds. We want to reflect what feels like what you're doing in your clients' portfolios. Because life insurance does two things really, really well. It's the most efficient way to pass on assets to the next generation and just that death benefit tax-free. And it's the most efficient thing I can think of to build cash value tax-free. I mean, it's a Roth alternative, right? And if we're going to do that, we should build portfolios that look like our Roth or 401k or brokerage account. And you can only do that in a life insurance product. You can only build an actual attractive investment portfolio when you have these partnerships. So, Tim, I always get a lot out of this in listening to you. And I think it's unique, right? That we can offer something like this, and then that you see it in the products we sell.
Lenny, do we have a quick second? I am on my testimonial train of the benefit access rider, which is really the reason
Sure.
why I bought my life insurance contract. Do I have a second to talk about that?
Absolutely, go for it. I'm going to bring up the piece.
Yeah. I'm sure, like many of you, you have clients who've had to do this march. I had to do it from the house to the assisted living center to hospice to the funeral home 4 times in the last year and a half. My wife's mom and dad went pretty fast, and then my mom and dad went pretty fast. And my parents did have long-term care insurance, but it was basic long-term care. And they had been paying premiums for years and years and years. And my dad was on claim for 1 month. My mom was on claim for 4. And I remember my family was like, wait a second, they paid these claims these premiums all these years. They're no longer here. Is there nothing left from those policies? And that it's a gamble. You don't know how long they're going to be in assisted living or hospice or whatever the case may be. It's just a sad conversation to have. But at the end of this, my wife and I sat down and we like, well, what can we do to make sure that this doesn't happen to us? And the feature of that benefit access rider on our life insurance contracts that we wrote in April, that's why we bought it. Yeah, there's a death benefit, but we really bought the ability to access it, really for our kids, for my son to access mine, for her daughter to access hers. When we do that march, when I lose my marbles, and there's something that is left if I'm on claim, like my dad for 1 month. So I'm a big believer in the benefit access rider.
Awesome. And I think this audience probably knows it because we've heard it. They've heard it from Bailey and I. But the key features, right? It's chronic illness. It's indemnity based. It grows with the death benefit. So that we've made an accumulation sale, or hey, cash matters all the time. It's a protection sale. It's guarantees. We've hit corridor. Death benefit has risen anyway because we have all these actual growth oriented funds. Yeah, if we never use it, or if it takes a longer to use it and the death benefit has risen, that's what we get to use on claim because it grows with the IRS per diem. It grows with our death benefit. It's not locked in. You took $1 million policy out 10 years ago. It's what it is when we go on claim. An absolute benefit. And something to add to it, it's a net amount at risk-based rider. So even if you put this on an accumulation product where we have a low death benefit, high relative cash value, you're a little drag when you have a net amount at risk-based rider where there's a little less for fee drag. So on most sales, it's can be an appropriate backup to have. Tim, anything else you want to cover? We're about 10 minutes to the hour. We've hit a bunch of our marks and taken up a good amount of time, but this has been great.
We do have
Just
another question that I
yeah.
think, Tim, before you continue, that I think most of the attendees would be interested in your answer. Mr. Zepeda comments, the letter R for recession. What time period do you guesstimate it will last? Most of those that he has witnessed were 1 to 2 years. Do you have a longer look?
Yeah, there's a picture I would refer to, and it's right at the bottom of that page. And the way to look at this is where you see these gray bars. That historically is the length of time, and you kind of have to look at the keys. To the right is the price level, and then at the bottom you see the different months. You kind of have to calculate. And a lot of these recessions have lasted. Some of them hardly even counted. If you go back to the COVID experience we had in 2020, um, it happened so fast that we actually did not dip into a recession. There actually were two negative quarters in a row of GDP numbers, but they were so slight due to the timing of things, such a severe downturn and such a really an incredible bounce that those weren't really considered to be recessionary times. We will have recessions, and I think that there's one thing that we do really well here in the United States is how well we redeploy capital. And it's not just money. It's not just moving things around. It's also people. And if you think about how dynamic our workforce is, and how our ability to work, especially in the service part of the economy, financial services or healthcare, whatever the case may be, a lot of this is being done now remotely from so many different places, thanks to the productivity gains in technology. And the way you grow economies is more people being more productive. So really, you need two things. You need productivity enhancements, and we have had tremendous things that have helped increase our productivity. And we're just now on the cusp of what artificial intelligence can do for our productivity gains. And then the second thing you need is a growing population. We're really the only developed country that has a growing population. Japan doesn't have a growing population. I wouldn't consider China to be a developed country, but if you take a tour around the globe, as big as our economy is, we have those two things working in our favor: growing economy and productivity gains. Those things give us the confidence to say that, hey, if we've got a Fed that's got their hand on the wheel, and we do have these numbers that come at us. Will they react quickly, and will they react appropriately? And so I think the depths of recessions, it's hard to predict these things, but we seem to be able to show the ability to redeploy capital if and when we have to do that to find more gain.
Thank you.
Well,
That
to summarize, I've covered a lot of ground. The RSVP, our overweights, our underweights. Hopefully, the four portfolios that I highlighted, the S&P 500, and then the three others for the S&P, where we exercise some pretty sophisticated loss mitigation strategies using options. We think it adds a robust menu to what we can do. And then just to iterate something that Lenny said is that the company index ratings, as much revenue as the Rock gets from life insurance, they also get revenue from other products that get distributed, mutual funds, annuities, and so forth, and the revenue that we generate as an asset manager. It's really the only company out there that has such a dominant position in life insurance and a dominant position in asset management. All of these different revenue streams add to the Rock. And I'd like to think that that's how Lenny is able to bring out these upgrades in a competitive and a quick manner that continues to put you in a superior position with your clients.
You
thank you,
agree?
Tim. Well said. Um, for those of you that have not had the privilege to work with Lenny, who I had said in the beginning of the call is our external rep from Prudential, extremely well versed on products, happy to help, happy to dig in with any of the advisors on the phone to further understand the products, the mixes behind the products and what they mean and how they work, and provide any assistance that you may need in order to help get the cases placed, whether it be understanding how the products work or everything from climbing the underwriting chain or the case management chain to clear out any backlog. Tim, we do have one final comment, which really is a plug, I think, for Prudential on a holistic basis, is that one of the advisors says his opinion of growth focuses on non-dividends. Amazon since September of 1999 has grown nearly 4,007%. When widows have loved their IRAs, he uses a multi-size cap equity portfolio structure. He encourages clients to own bonds and a mixed equity portfolio, including Prudential annuities for cash reserve plus insurance. And I think with that, he checks the majority of the boxes. What do you think?
Agreed. When it comes to growth investing, the idea there is that if I'm a growth company like the one you mentioned, and we have free cash flow, we have money that we've made. The telegraph of a growth company is like, you know what? We think the best investment out there is ourselves, rather than maybe doing share buyback or paying that dividend. Where what that says is like, look, we're making money, we're doing pretty good, but why don't you go find something that's a good investment? No, 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 no. We think the best investment of the money as a shareholder on your behalf is to double down and to do more of what we're doing that made that money in the first place. Really a strong characteristic of a growth company. And I know that I'm counting on Jennison and the Jennison growth portfolio in my own contract to do that for the portion that I put there.
Thank you. At this point, we are almost at the top of the hour. If anybody has any additional questions or comments, please type them into the chat or the Q&A. With the few minutes that we have left, is there anything else, Tim, that you wanted to cover that you think is would be beneficial for our audience to hear?
Well, I think that's a full boat. We've got so many other portfolios that we have not talked about. I think if you look at the full list that was up on the screen earlier with Lenny, I just want to make myself available to support Lenny. I look at Lenny as my frontline client, if you will. I do what he tells me to do. I go where he tells me to go. But we're here to help and answer any and all questions at any time. And just to say thank you for the business that you've sent our way. Thank you.
And thank you. There are folks on the phone that are asking for contact information. We will provide that in an email offline with a follow-up, so you can look forward to receiving that. This presentation has also been recorded. It will be on the Agency One website. Lisa, somebody asked me if it was video recorded. Is it video or just audio? Lisa, you're on mute.
Yes, can you hear me?
Yes.
It is video recorded. Yes.
Terrific. Thank you. Lenny, do you have any further comments? If not, I'm going to turn this over to Lisa, so you can either turn it over to her or I will, and then she'll turn it back to me.
Just again, yeah, my contact info. There's nothing you can't call me about. Please do, as long as it's about Prudential. I'm going to be sending these pieces, right? So you'll get anything we talked about or screen shared, you're going to get. And then I'm just going to plug, right? Lisa and I are planning our next webinar to do with Mike Connell from our advanced planning team. And I think everyone who's worked with Pru's probably heard us talk about loan rescue. And we're moving on to moving just not from loan rescue, but collateralized lending, premium finance rescue. And just keep an eye out for those invitations. They'll be coming out for this fall.
Those are great topics. Thank you.
Yep.
And that's where we were going to turn this over to Lisa. Lisa's going to talk
Thanks,
about
Kath.
upcoming webinars.
Thanks a lot. We've got for August, we've got 3 webinars coming up in August. August 5th and 26th are with John Hancock again, and they'll be finishing up their You're the Boss series. The 5th, there'll be the focus on the family. The 26th will be the focus on heirs. be watching for invitations to those going out this week. August 12th, we'll be featuring Principal. Principal is going to also be focusing on business solutions and how to stand out in the business market. And they'll be discussing their robust solutions and their unique approach to the small business market. So we hope you can join us for those webinars. Again, watch for an invitation for all 3 of those webinars coming this week. Thanks a lot.
Thank you, Lisa. On behalf of Agency One, thank you very much for dialing in and for your attention the past hour. We hope that you found this valuable and additive to your practice. Again, if you have any questions, comments, concerns, if Agency One can help you in any way, please reach out to myself, to Gonzalo, or to your case managers, or to Dennis, and we are happy to help. I hope everybody has a great week. Thank you, Tim, and Lenny, and Bailey. I see that you're on the phone, and thank you for all of your help in supporting Lenny. And on behalf of Agency One, thank you for your time, and we look forward to talking with you soon.
Thank you.
Thanks all.